Today we're diving into one of the most crucial and often overwhelming parts of buying a home: financing and mortgages. Hey, welcome back to my channel. If you're new here, once again, my name is Whitney Michael. I am your go-to realtor in the Hampton Roads, Virginia area. I'm here to make the home buying and home selling process as smooth and stress-free as possible. Getting your finances in order and understanding your mortgage options is absolutely essential to turning your dream of home ownership into a reality. Whether you're a first-time buyer moving up to your next home, or even looking to downsize, this video will equip you with the knowledge you need to navigate the complex world of home financing. So let's get started. Let's kick things off with the basics. What exactly is a mortgage? In its simplest form, a mortgage is a loan that's used to purchase a home. When you take out a mortgage, you're borrowing money from a lender to purchase the property, and in return, you agree to pay back that loan with interest over a set period of time, usually 15, 20, or 30 years. Think of a mortgage as a financial partnership between you and the lender. You get the funds you need to buy the home, and the lender gets paid back over time with interest, of course. The key to making this partnership work in your favor is understanding the terms and choosing the right mortgage that fits your financial situation. One important concept to understand is amortization, which is how your loan payments are spread out over time. Early on, a larger portion of your payment goes toward interest, but as you progress, more of it goes towards paying down the principal. This is why it's crucial to stay on top of your payments, and if possible, consider making extra payments towards your principal to reduce the amount of interest you'll pay over the life of the loan. I cannot stress that enough. Even if you only pay $20 or $50 extra a month, it will help. Now that you have a basic understanding of what a mortgage is, let's dive into the different types of mortgages that are available. Choosing the right one can make a huge difference in your monthly payments and the total amount you'll pay over the life of the loan. First up is the fixed rate mortgage. This is the most traditional mortgage type where your interest rate remains the same for the entire term of the loan. Whether it's 15, 20, or 30 years, it doesn't matter. That interest rate stays the same. The biggest advantage here is predictability. Your monthly payments stay the same, which makes budgeting easier and provides peace of mind knowing your rate won't change regardless of what happens in the economy. Now, segue. Your property taxes and your homeowner's insurance will go up eventually. Next, we have the adjustable rate mortgage, also known as an ARM. Unlike a fixed rate mortgage, an ARM offers a lower initial interest rate, which can be appealing if you're looking to save money up front. However, after the initial fixed period, let's say 5, 7, or 10 years, the rate adjusts annually based on the market. This can be a great option if you plan to sell or refinance before the adjustable period kicks in, but it does come with some risks. If interest rates rise, your payments could increase significantly. Then there are government-backed loans like FHA, VA, and USDA loans. These are fantastic options if you qualify, offering benefits like lower down payments and flexible credit requirements. For example, an FHA loan backed by the Federal Housing Administration is popular among first-time home buyers because it allows for down payments as low as 3.5%. VA loans backed by the Department of Veterans Affairs offer incredible benefits for veterans and active duty service members, including the possibility of zero down payment. Each type of mortgage has its own set of benefits and potential drawbacks, so it's crucial to discuss your options with a knowledgeable lender or financial advisor who can help you find the best fit for your unique situation. Remember, the right mortgage can save you thousands of dollars over the life of your loan, so take the time to understand your options. Before you even start house hunting, it's a smart move to get pre-approved for a mortgage. Pre-approval is like getting a financial green light from a lender, indicating how much they're willing to lend you based on your specific financial situation. This step not only shows sellers that you're a serious buyer, but it also gives you a clear idea of your budget. Here's how the pre-approval process works. First, you'll need to gather and provide financial information to your lender, including details about your income, assets, debts, and credit history. The lender will review this information and determine how much they're willing to lend you. Once approved, you'll receive a pre-approval letter, which you can use to show sellers that you're ready to make a competitive offer. Having a pre-approval letter in hand can give you a significant edge in the competitive market where multiple offers on homes are common. It not only shows sellers that you're a serious buyer, but it also helps you stay within your budget, ensuring you're looking at homes that you can actually afford. And remember, a pre-approval isn't the same as a final approval. Your lender will still need to verify certain details and your financial situation before giving you the final green light. But having that pre-approval letter is a strong first step in the home buying process. And here in Hampton Roads, we typically do not submit an offer without having a pre-approval letter. We won't even show homes without having a pre-approval letter. So get yourself pre-approved. Interest rates are a key factor in determining how much you'll pay over the life of your mortgage. And even a small difference in the rate can have a big impact. It is essential to understand how interest rates work and what factors influence them. Let's break it down with an example. Suppose you're borrowing $300,000 at a 3% interest rate. Your monthly payment would be around $1,265. But if the interest rate were 4%, that monthly payment would increase to about $1,432. Over a 30-year period, that's nearly $60,000 more you'd be paying just for a 1% increase in the interest rate. This is why it's so important to shop around for the best interest rate. Even a small percentage difference can add up to a significant amount over the life of your loan. Additionally, you'll need to decide on the term of your mortgage. A 15-year mortgage, for example, will have a higher monthly payment, but you'll pay significantly less in interest overall compared to a 30-year mortgage. Your choice between a shorter or longer term will depend on your financial goals and your monthly budget. A shorter term might save you money in the long run, but only if you can comfortably afford the higher payments. Let me say that again, only if you can comfortably afford the higher payments. It's all about finding the right balance. Now, let's talk about down payments. The down payment is the amount of money you pay up front when buying a home, and it's usually expressed as a percentage of the home's purchase price. While 20% is often considered the standard, there are many loan programs available that require much less. For example, with an FHA loan, you might be able to put down as little as 3.5%. Conventional loans might require 5% to 10% down, but they can go as little as 3% down depending on your credit score and financial situation. And as I mentioned earlier, VA loans may not require any down payment at all. And typically, VA loans do not require a down payment. However, if your down payment is less than 20%, you'll likely need to pay for private mortgage insurance, also known as PMI. PMI protects the lender in case you default on the loan, but it's an extra cost that you'll need to factor into your monthly mortgage payments. PMI can add hundreds of dollars to your monthly payment, so it's something to be aware of. The good news is that once you've paid down enough of your mortgage to reach 20% of equity in your home, you can typically request to have PMI removed, reducing your monthly payments. While PMI can be an added expense, it's also a trade-off that allows you to buy a home sooner rather than later, even if you don't have a full 20% saved up. The key is to understand how it fits into your overall financial plan and to make informed decisions based on your unique circumstances. Now, before we wrap up, let's quickly recap the key points we've covered today. First, understanding the basics of mortgages is crucial. Know what you're getting into and make sure it aligns with your financial goals. Second, explore different types of mortgages and choose the one that's right for you. Third, Getting pre-approved is a must before you start shopping for homes. Fourth, be mindful of interest rates and loan terms, and remember that a small difference can have a big impact. Finally, consider your down payment options and understand how PMI could affect your budget. Buying a home is one of the biggest financial decisions you'll make, and having the right information is key to making a smart choice. I hope this video has demystified the financing and mortgage process for you, giving you the confidence to take the next step toward owning your dream home. If you found this video helpful or valuable, please do not forget to like, subscribe, and hit the bell so you never miss an update. And as always, if you have any questions or you need personalized advice, feel free to reach out to me. I'm here to help you every step of the way. Thank you for watching. I'll catch you in the next video. Peace.